Listen carefully, because what you are about to hear could change the way you protect your future forever. We are standing at a turning point most people won't recognize until it's too late. Markets are shaking, currencies are weakening, and confidence in traditional systems is quietly eroding. History is whispering a warning, but only a few are paying attention. Every era of financial stress has one thing in common. When paper promises fail, people return to what has always endured. Not trends, not hype, not speculation, something older than governments, stronger than currencies, and trusted when everything else breaks. For generations, people believed safety came from institutions. But today, debt grows faster than productivity. Money is created faster than value, and the cost of living rises while savings lose strength. This is not an accident. It is a pattern, and patterns repeat. Here's the truth most won't tell you. Wealth isn't built by chasing returns. It's built by protecting value first. When uncertainty rises, capital doesn't disappear. It moves. It flows towards scarcity, towards certainty, toward assets that cannot be diluted, printed, or promised away. The biggest financial shifts don't happen overnight. They build quietly while distractions dominate headlines. By the time the crowd realizes what's happening, the opportunity is already gone. This is why preparation matters more than prediction. Think long-term, think survival, think legacy. Those who understand cycles don't panic. They position themselves. They know that when trust declines, timeless value rises. And when confidence finally breaks, protection becomes priceless. This moment is not about fear, it's about awareness. Because the greatest transfers of wealth don't reward the loudest voices. They reward the calm, disciplined, and prepared. Remember this: trends come and go, systems change, but real value never disappears. Those who respect that truth don't just survive uncertain times. They emerge stronger than ever. Stay alert, stay prepared, and above all, protect what you've worked so hard to build. Uncertainty fuels real value because uncertainty exposes the fragile foundations most people rely on without question. When systems appear stable, trust feels automatic. People believe numbers on screens represent safety, that promises will be honored, and that tomorrow will look like today. But when uncertainty enters, through economic stress, rising debt, inflation, or sudden market shocks, that trust begins to crack. And once trust weakens, the true test of value begins. In those moments, people stop asking how much something can grow and start asking whether it can endure. History shows this pattern with ruthless consistency. Every major financial upheaval forces a reassessment of what is real and what is merely assumed. Systems built on confidence function only as long as confidence remains intact. When that confidence erodes, speed replaces patience, fear replaces comfort, and capital searches for certainty. It does not disappear, it migrates. It moves away from complexity and toward simplicity. It moves away from promises and toward proof. That is when timeless assets rise, not because of hype, but because they answer the most important question of all: what still holds value when belief is gone? Uncertainty strips away illusion. It reveals how quickly paper assurances can weaken and how fragile modern structures become under pressure. When rules change overnight, when purchasing power declines silently, and when long-standing assumptions fail, people rediscover an old truth. Real value is not created by trust alone, but by scarcity, durability, and independence from human decision-making. Assets that cannot be inflated, rewritten, or diluted suddenly matter again, not because they are exciting, but because they are reliable. This shift does not happen emotionally at first. It happens logically. Investors and individuals begin to notice small signals. Currencies buying less than before, savings losing strength, volatility becoming normal instead of rare. These signals accumulate. At first they are dismissed, then they are debated. Eventually, they are undeniable. And when denial breaks, behavior changes. Safety becomes more valuable than growth. Preservation becomes more important than speculation. The mindset transforms from "how fast can I win?" to "how do I avoid losing?" Timeless assets rise in uncertain periods because they exist outside fragile frameworks. They do not depend on political promises, quarterly decisions, or artificial confidence. They are not someone else's liability. They have survived wars, collapses, resets, and revolutions. not because they adapt, but because they remain fundamentally unchanged. In times of clarity, this stability feels boring. In times of chaos, it becomes priceless. Uncertainty also exposes a psychological truth. People underestimate risk during calm periods and overestimate stability during long expansions. When comfort lasts too long, vigilance fades, but uncertainty wakes people up. It forces uncomfortable questions about exposure, dependence, and resilience. Those questions naturally lead toward assets that require no explanation when things go wrong. Value that needs no justification under stress is the kind of value that endures. This is why major financial shifts always seem obvious in hindsight. The warning signs were there, but comfort muted their urgency. Uncertainty simply removes the noise. It clarifies priorities. It separates what performs well on paper from what holds firm in reality. And when that clarity arrives, capital flows toward what has always worked when trust breaks down. Real value does not need perfect conditions to survive. It thrives precisely because conditions are imperfect. It rises not during moments of optimism, but during moments of doubt. And as uncertainty grows, so does the demand for what cannot be questioned, rewritten, or erased. Money can be printed, but scarcity cannot, and this single truth explains why real wealth behaves differently from ordinary income. Modern money is built on trust and policy, not limitation. When economies slow, when debt expands, or when pressure mounts, new currency can be created instantly. This ability may stabilize systems in the short term, but it quietly erodes purchasing power over time. The numbers in an account may rise, yet what those numbers can buy steadily declines. This is how wealth is lost without ever being stolen. True wealth is not measured by how much money you have, but by how much value your money can command in the real world. When currency expands faster than goods, services, and productivity, each unit becomes weaker. This process is subtle at first. Prices rise slowly, explanations sound reasonable, and most people adjust without resistance. But over years, the effect compounds. Savings work harder yet buy less. Wages increase, but lifestyles remain stagnant. The illusion of progress hides the reality of dilution. Scarcity changes everything. Assets that cannot be multiplied at will do not suffer this quiet decay. Their value is anchored not to policy decisions or emergency measures, but to fixed supply and natural limitation. When more money chases the same scarce resources, prices adjust upward, not because the asset is changing, but because the measuring stick is shrinking. Scarcity does not need growth to create wealth. It only needs time and excess currency to reveal its strength. This is why true wealth is defensive before it is offensive. It does not depend on perfect timing or aggressive strategies. It focuses on maintaining purchasing power across decades, not outperforming in a single year. While money is designed to move, circulate, and be spent, real wealth is designed to endure. It holds value while systems shift around it. It remains relevant even when rules change. The danger of printable money is not its existence, but our dependence on it. When people believe currency alone equals wealth, they expose themselves to forces beyond their control. Policy decisions, interest rates, and economic shocks can reshape outcomes overnight. Scarce assets remove part of that risk because they do not rely on trust and continuous restraint. They rely on limitation, and limitation is immune to promises. Preserving purchasing power is an act of foresight. It means recognizing that tomorrow's prices will not resemble today's, and that stability is not guaranteed simply because it existed yesterday. Those who understand this do not panic during expansion or collapse. They quietly anchor part of their wealth in what cannot be diluted. They accept that real security is not about maximizing numbers, but about maintaining relevance in a changing world. Over time, the difference becomes undeniable. Printed money demands constant motion to survive, while scarcity allows value to sit still and grow stronger by comparison. One races against erosion, the other stands firm as erosion accelerates. This is why true wealth outlasts cycles, governments, and policies. It does not fight the system, it exists beyond its reach. Debt always demands a reckoning because borrowing is not wealth creation, it is time-shifted consumption. It brings future resources into the present and disguises the cost with delay. At first, debt feels harmless, even productive. Growth accelerates, lifestyles expand, and systems appear stronger. But beneath the surface, pressure builds. Every borrowed unit carries an obligation, and when borrowing becomes excessive, repayment stops being a choice and becomes an inevitability. History does not debate this outcome. It repeats it. Civilizations, empires, corporations, and households have all followed the same arc. Debt rises faster than income. Servicing costs grow quietly at first, then suddenly dominate. Leaders promise control, restructuring, or innovation, but mathematics is immune to optimism. When obligations compound faster than the ability to repay them, something must give. Either the debt is honored through pain, or it is diluted through devaluation. There is no third option. The danger of excess borrowing lies in how normal it becomes. When debt is cheap and abundant, restraint disappears. Risk feels manageable, warnings feel outdated, and leverage becomes standard practice. Entire systems are built on the assumption that growth will always outrun obligations, but growth is not guaranteed. Productivity slows, demographics shift, external shocks arrive, and when momentum fades, the weight of accumulated promises becomes impossible to ignore. Reckoning does not always arrive as a dramatic collapse. Often it comes quietly. Purchasing power erodes, taxes rise, returns shrink, savings lose strength, people work harder just to maintain the same standard of living. This slow drain is still a reckoning, even if it lacks headlines. It is the cost of past excess being paid over time instead of all at once. Debt also distorts decision-making. When obligations are large, choices narrow. Policies are designed to delay consequences rather than solve problems. Short-term relief replaces long-term stability. This creates a cycle where more borrowing is used to cover previous borrowing, pushing the reckoning further into the future while making it more severe. What begins as flexibility ends as dependency. Those who study history understand that debt crises never resolve through denial. They resolve through sacrifice, restructuring, or loss of value. Wealth that relies solely on systems overloaded with obligations becomes vulnerable during these periods. When confidence breaks, promises are questioned, and what once seemed secure is suddenly negotiable. Recognizing this pattern is not about fear, it is about realism. Excess borrowing is not a modern innovation, and its outcome is not uncertain. The timeline may change, the language may soften, but the result remains the same. Obligations cannot outgrow capacity forever. When the reckoning arrives, it exposes the difference between perceived wealth and real resilience, rewarding those who prepared for inevitability rather than comfort. Safe havens become crowded before the storm because intelligent capital does not wait for confirmation from headlines. It moves when signals are still subtle, when comfort remains high and urgency feels unnecessary. Smart money understands that protection loses effectiveness once fear becomes widespread. By the time danger is obvious to everyone, safety is expensive, limited, and often inaccessible. The greatest advantage lies not in reacting quickly, but in positioning quietly. Early movement is rarely dramatic. It does not announce itself with bold predictions or public panic. It happens through gradual reallocation, diversification, and subtle shifts away from vulnerability. These actions look boring in stable times and even foolish when markets are soaring, but they are rooted in discipline rather than emotion. Smart money values asymmetry, limited downside, and meaningful protection if conditions deteriorate. Crowding is a signal, not a strategy. When everyone rushes toward the same refuge at the same time, prices inflate, liquidity tightens, and the margin of safety shrinks. What once offered protection now carries risk of its own. Late arrivals mistake popularity for security, unaware that the very act of rushing in undermines the purpose of safety. True havens are meant to be entered calmly, not chased desperately. Those who move early are guided by probabilities, not predictions. They observe rising leverage, expanding deficits, and increasing volatility. They recognize that calm markets often hide growing fragility. Rather than waiting for a crisis to force decisions, they act while choices are still flexible and costs are still reasonable. This is not pessimism, it is preparation. Smart money also understands psychology. Fear spreads faster than logic. When uncertainty spikes, decision-making deteriorates. People cling to familiar narratives or follow the crowd, believing consensus equals safety. Early movers avoid this trap by acting before emotions dominate behavior. They know that once panic sets in, rational planning gives way to urgency, and urgency leads to mistakes. Moving early does not mean abandoning opportunity. It means balancing growth with protection. It means accepting that some returns may be sacrificed in exchange for resilience. This trade-off is invisible during expansions, but invaluable during contractions. The goal is not to escape every downturn, but to remain intact and positioned when others are forced to recover. Silence is a feature of intelligent positioning. There is no need for loud warnings or dramatic forecasts. The most effective protection is built quietly, long before it is needed. When the storm finally arrives, crowded exits and inflated shelters reveal who prepared and who waited. Smart money is already in place, not searching for safety, but calmly observing from it. Protection comes before profits because wealth that cannot survive cannot compound. Long-term success is not built by the biggest gains, but by the ability to stay in the game through every cycle. Losses hurt more than gains help, and a single severe drawdown can erase years of progress. This is why survival is the first and most important rule of wealth creation. Without protection, growth is temporary. With protection, time becomes an ally. Most people focus on upside during good times. They chase returns, compare performance, and assume favorable conditions will continue. But markets and economies are cyclical, not linear. Periods of expansion are always followed by contraction. Those who ignore this reality expose themselves to risks that only become visible when it is too late. Protection is not pessimism, it is respect for volatility and uncertainty. True protection is not about avoiding risk entirely, but about managing it intelligently. It means understanding what can go wrong before focusing on what can go right. It means building resilience into decisions so that unexpected events do not force irreversible outcomes. When survival is prioritized, choices become more disciplined. Leverage is controlled. Concentration is limited. Liquidity is valued. These decisions may reduce short-term excitement, but they dramatically increase long-term durability. Profits are meaningless if they cannot be kept. Many fortunes are lost not because of lack of intelligence, but because of overexposure. When conditions shift, those without protection are forced to sell at the worst possible moments. Fear replaces strategy, and temporary setbacks become permanent losses. Survivors, on the other hand, retain flexibility. They are not pressured into decisions by urgency. They can wait, adapt, and even capitalize on opportunities created by others' distress. Protection also preserves clarity. Stress distorts judgment. When people fear total loss, they abandon plans and react emotionally. Those who have protected their downside operate from a position of calm. This mental advantage is as valuable as any financial asset. It allows rational decision-making when chaos surrounds them, and rational decisions compound over time. Long-term wealth is built slowly and destroyed quickly. This asymmetry demands humility. No strategy is immune to change. No environment remains favorable forever. Protection acknowledges these truths and builds margins of safety around them. It accepts that being slightly conservative during good times is a small price to pay for staying intact during bad ones. Survival does not mean stagnation. It means ensuring that setbacks are temporary and recoverable. Those who prioritize protection remain present through every cycle, allowing time, discipline, and compounding to do their work. In the end, the winners are not those who took the greatest risks, but those who never gave risk the power to end their journey. Those who prepare win because preparation does not depend on being right about the future. Prediction demands precision, timing, and certainty in a world that offers none of them. Foresight, on the other hand, accepts uncertainty as a constant and builds strategies that function across multiple outcomes. It does not ask what will happen next, it asks what could happen and whether the plan can survive it. This mindset is what separates lasting success from repeated disappointment. Reactive behavior is rooted in surprise. It waits for confirmation, headlines, or visible damage before taking action. By the time reaction begins, options are limited and costs are higher. Markets have already moved, narratives have already shifted, and emotion has already entered the equation. Reaction is almost always expensive because it occurs under pressure. Preparation happens without urgency, when choices are abundant and clarity is intact. Foresight is not about forecasting exact events. It is about recognizing patterns, cycles of expansion and contraction, leverage and deleveraging, confidence and fear repeat across generations. While the triggers change, the behaviors remain remarkably consistent. Those who prepare study these patterns and position themselves accordingly. They do not need to know the date of a downturn to respect its inevitability. They understand that resilience is built before stress, not during it. Preparation also creates optionality. When resources are protected and risk is controlled, opportunities become accessible. Crises do not only destroy value, they redistribute it. Those who prepared are not forced sellers. They are not scrambling for liquidity. They are able to act deliberately while others are frozen by uncertainty. This ability to choose rather than react is a powerful advantage. Prediction appeals to ego. It promises certainty, confidence, and validation. But even accurate predictions can fail if timing is off or conditions change unexpectedly. Preparation appeals to discipline. It requires humility and patience. It accepts that being early often feels uncomfortable and unrewarded. But over time, this discomfort becomes strength. Prepared individuals endure periods of underperformance knowing they are building durability rather than chasing applause. Those who react are guided by emotion. Fear and excitement alternate, pulling decisions in opposite directions. Each move is influenced by what just happened, not by what could happen next. This creates a cycle of buying late, selling early, and constantly adjusting without a stable foundation. Preparation breaks this cycle by establishing rules and buffers before stress arrives. Foresight beats prediction because it works even when the future refuses to cooperate. It does not rely on accuracy, it relies on readiness. When conditions shift, those who prepared are already positioned, already protected, and already thinking clearly. They do not need to be faster than everyone else. They simply need to be ready before readiness becomes rare. Everything you have heard comes down to one simple reality. Uncertainty is not an exception, it is the default. Systems change, confidence breaks, debt accumulates, and cycles repeat whether people are ready or not. The difference between those who struggle and those who endure is not intelligence or luck, but preparation and discipline. Real wealth is built by respecting scarcity, understanding risk, and protecting value long before protection feels necessary. When others are distracted by comfort or noise, those who prepared stand steady. They do not rush, they do not panic, and they do not depend on fragile promises. They understand that lasting security is created quietly through foresight, resilience, and patience, allowing time to work in their favor while the unprepared are forced to react.